The US stock market keeps going up, but everyday life feels more expensive and uncertain. If the economy is weak, why aren't stocks falling? This disconnect isn't accidental. It's the result of how modern markets really work. First, the stock market is not the same thing as the real economy. The economy reflects jobs, wages, rent, food prices, and daily living cost. The stock market reflects corporate profits, future expectations, and investor behavior. When people say the economy feels weak, they're usually talking about households. When markets rise, they're reacting to something else entirely. One major reason stocks stay strong is large corporations. Most major indexes like the S&P 500 are dominated by a small group of powerful companies, especially in technology. These companies earn money globally, not just in the US. Even if American consumers slow down, global demand, cloud services, AI, and software subscriptions continue generating massive profits. Investors follow earnings, not emotions. Another key factor is interest rates and expectations. Even when rates are high, markets move on what they believe will happen next. If investors expect rate cuts in the future, they start buying early. Stock prices are forward-looking, often 6 to 12 months ahead. That's why markets can rise even when current data looks weak. Then there's inflation psychology. Inflation hurts consumers, but it can actually help some companies. Higher prices mean higher revenues. Many businesses pass increased costs directly to customers, protecting their profit margins. As long as profits remain stable, stocks don't collapse. We also can't ignore institutional money. Pension funds, hedge funds, and large investors must stay invested. They don't sit in cash for long. When money has nowhere else to go, bonds look risky. Cash loses value to inflation. Stocks become the default option. This constant flow of capital supports the market, even during economic stress. Another important reason is government and Federal Reserve signaling. Markets believe that if conditions get too bad, support will come through rate cuts, liquidity, or policy changes. This belief creates a safety net in investors' minds, reducing panic selling. But here's the reality many miss. A rising stock market does not mean most people are doing well. Wage growth hasn't kept up with housing, healthcare, and debt cost. Credit card balances are rising. Rent remains high. The market can celebrate while households struggle. Both things can be true at the same time. And looking ahead, this gap between Wall Street and everyday Americans is unlikely to close quickly. Even if inflation slows, higher rents, healthcare costs, and debt payments will continue to pressure households. Meanwhile, markets will keep reacting to earnings reports, interest rate expectations, and global capital flows, not daily struggles. That's why a rising market doesn't automatically mean economic comfort. It simply reflects where money is moving, not how people are living. Understanding this difference helps investors and viewers avoid confusion, fear, and false signals in today's economy.